Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Kevin Mahn. He's the Chief Investment Officer of Hennion and Walsh, and he's here to discuss why better days may be ahead for the overall markets. Kevin, it's quite appropriate. Spring has sprung this week.
It has.
We're looking forward to warmer weather, better days in the markets, and you've been so consistent with your messaging since March of last year. The Federal Reserve's primary focus has been doing what it needs to do to fight inflation until something breaks.
Correct.
And something has broken. How is the impact being felt?
Yeah, not only are my March Madness brackets broken at this point in time, but things have broken in the economy, whether it's housing, banking, the consumer, and ultimately we're going to soon see earnings and the economy as well. So if there is a silver lining to this banking crisis, Jill, it's that the Fed is not going to be as aggressive as they wanted to 2 weeks ago with respect to raising interest rates because the economy clearly cannot handle it. So I believe that the Fed still goes up 25 basis points more, whether that's in May or June, and then they stop and they sit back and assess the overall amount of damage they've done to the U.S. economy, which I believe is going to be significant. But if they do stop, better days are indeed ahead, and now might be the right time to start investing in those areas that have really beaten up in 2022.
Right, and you had suggested this earlier in the year, back in January, that better days are ahead in the market for 2023, although not necessarily the economy. The markets and economy are two different things. That's playing out.
Certainly.
Where are you seeing light at the end of the tunnel?
So there's a couple areas I see light. In terms of the sectors that we see attractive valuations and opportunities for growth as the economy starts to recover from this economic slowdown, which may very well lead into a recessionary territory during the first half of this year, it's the beaten up areas of technology, consumer discretionary, and even the biotech component of healthcare. Those are the three areas that were beaten up the most, and those are the three areas that really provide the innovation and the leadership to the U.S. economy during periods of growth. That growth may start to take place in 2024 to 2025, and now may be the right time to buy into those more attractive valuations.
And you still like dividend stocks?
I love dividend stocks from quality companies with strong balance sheets, free cash flow, and there are three names that we actually like in those three particular sectors, and we hold them all within the Smart Trust New American Economy Trust. Those names on the technology side are Broadcom. Certainly we've all heard of Broadcom. It's a key component for the infrastructure solutions that most companies need to survive and thrive in this type of economic environment, and it pays a pretty good dividend too, above 2%. And then on the consumer discretionary side, perhaps it's even more consumer staples now, given our country's affinity for sports and exercise, but Dick's Sporting Goods. They also pay a dividend above 1.5%, free cash flow in their balance sheet, and low debt to asset ratio. And then lastly, in the biotech arena, and this name was in the news early this morning on a positive note, but Regeneron Pharmaceuticals, a larger cap biotech name, and we really see opportunities for growth in the entire biotech area as it relates to M&A activity over the next couple of years. So better days ahead for the market, certainly, but the economy is in for a tough go these next couple of quarters.
Well, you'll be happy to know my family contributes to the bottom line of Dick's Sporting Goods, so we're rooting
for
you.
you.
What about bonds? What area in bonds looks attractive?
Yeah, we really like municipal bonds, as we always do at Hennion and Walsh, but certainly in this environment, just look at the supply-demand imbalances that exist for municipal bonds. By the end of 2024, 21% of all outstanding municipal debt across our country is scheduled to either be matured or called. Go out 2 more years, 2026, that number becomes 31%. 1/3 of all municipal debt in our country is scheduled to either be called or mature by the end of 2026. Do we really think municipalities are going to issue new debt in this yield environment? Or are they going to wait a couple years knowing that that debt's coming in and when yields should likely be lower? We think they're going to wait. Less supply, increased demand generally leads for an upward movement in prices.
And you also like the tax profile of munis?
Absolutely, especially for high net worth investors who are looking for areas of tax-free income with the threat of higher personal income taxes ahead of them. We think that becomes even more attractive to those types of investors in the months ahead.
All right, Kevin, appreciate the insight as always. Thanks
My
for
pleasure,
joining us
Jill.
on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.